If you're using cash or income to pay for your car, you're doing it all wrong. Here's how smart investors buy their car for Let's do this. Hi, I'm Christoph Marzik. I've been a professional trader and investor for almost 20 years, and I'm on a mission to make you a better trader, investor, and ultimately have a better life.
Open your boxes. 1, 2, 3. You get a car! 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 Everybody gets a car!
Alrighty, indeed, everybody gets a car. You get a car. You get a car. All right, welcome to part 2 of how savvy investors buy cars. If you've watched part 1, you've seen the setup: a 60-month loan for a car purchase. We went through a normie loan, the savvy loan, a savvier loan. In part 2, we're going to compare the 3 loans. What are the requirements to do this? What is a box trove loan? We're going to do a brief overview at a high level. Why the box loan is better than a margin loan. What are the risks? How can we mitigate some of those risks? And then we'll conclude the video. All right, let's do this. You've made $8,900. You got the car for free, plus you made money, folks. Are you seeing this? You saved $78,000. Whoa. How is this possible? It is possible. I can tell you firsthand that I purchased a car like this. This is how I do it, okay? Here's a side-by-side. The purple areas is the apples to apples comparison, okay? So the normie loan, you lose $37,000. The savvy but not as savvy, which means you're not making the payments, okay? They're missing here. You gain $23,000. And the last one here, the savvier you make the payments, you make $41,000. Again, if you decide to keep the car, that's the blue area. You paid that much, you paid that much, and you paid that much. Decent spread here of owning a car. Paying for your liability is normie. Paying for assets is sophisticated, savvy. That's you. That's why you're here. That's why I'm here. I'm here to empower you. I want you to make better decisions. I want you to be thinking like this. Okay. How to set this up? How do we actually do this? First of all, you need a taxable investment account. There's no denying that, okay? You need cash of at least 1.25x the value of the car, okay? Okay, this is an example. Buying a car for 50 grand, you need 62,500, okay? Ideally, you want to go 2x, okay? You don't want to over-lever. I wouldn't suggest you over-lever, but if you got a couple hundred grand in the account and then you want to go buy a car for 50 grand, this is a pretty juicy way to do it. If you have $1 million in the account, you're like, I'm going to go get that Ferrari for 180. Go and do it. This is the way to do it. And I'm going to show you why that makes tons of sense here. You need options trading approval from your broker. At least level 3, possibly level 4 or 5. If you don't know what that means, you could ask your broker, hey, I need options approval. They might give you a little questionnaire or something, some sort of form to fill out. Go for the highest level if possible, okay? You'll need a margin account. At least Reg T, 50%. That's minimum. You can't do this otherwise. Also, why you need this all needs to be in a taxable account, not in an retirement account, okay? You may want portfolio margin accounts. That's if you want to leverage even more. Again, there's a way. I mean, you can lever this thing up. You can borrow only, or you could borrow 80%. You're at higher risks, and we're going to go over the risks later. And you have to be willing to stay invested, i.e. you need time, okay? Let's go through what exactly on a high level. This is super high level. I'll have another video where I go a little bit less high level, and probably a third video where I go deep dive, okay? In every options contract, there's an interest rate embedded into the pricing. This strategy, you use 4 legs where you're creating a synthetic buy position, a synthetic short position. When you do that, you're removing all directional risk, and you're isolating that priced in interest rate. That becomes your loss when you sell this thing. When you buy it, actually, there's a flip side of this. You're actually gaining that interest rate. What is the interest rate? It's always tied to the risk-free interest rate down the curve, okay? So if the risk-free interest rate is 4%, you're going to get somewhere in the ballpark of 4.5, I'd say. It's typically like 40 to 100 basis points higher. The funny thing is, you're not going to see this very advertised. This is a very well-documented, long-standing strategy going back from the 80s. Okay, we're talking 40 plus years now. People in the know about it. People also in the know who are on the other side of creating margin loans, they know about it and they don't want you to know about it, okay? Because they're out there charging the risk-free rate plus 300 basis points or 400 basis points or whatever. 8, 9, 10% type of loans. This is a shortcut through that. Some of the brokers don't even want to let you execute this trade. So you have to be aware of this. This little hidden secret sauce. Why do the box trove loan rather than a broker margin? Okay, you'll have risk-free rates plus a few basis points. So for example, if I go out to 5 years right now, if I go out to 5 years, the risk-free rate is about 4.41. So I could probably get somewhere about 4.8, maybe 5, maybe 5.1, somewhere around there. Okay. You're not going to get that at your broker margin account. That's just too low. If you are getting that, you've either negotiated it down or you have a very high balance. Typically one of those, or a good relationship with your broker. The other nice thing here is you get a fixed interest rate. Let me go back to drawing. Sorry. You get a fixed interest rate during the life of the loan. The broker margin might change. It changes daily, okay? And it'll change based on what the Fed is doing. This is fixed. You lock it in for the 5 years. Similar to a broker loan, you're staying invested in the markets. That's not really a huge benefit difference. This one is, though, the balloon payment treatment. You don't have to make the payments. I'm going to suggest that you do to lower your risk. I'll show you why. But you don't have to. Therefore, you can remain fully invested or even invest more in the market. This one's huge, and I didn't include this one in any of my calculations. I should be very clear here. None of this is included in the calculations. The tax deductibility, no matter the use of funds, so the interest portion is tax deductible. They don't want you to know this either. Okay, this is a huge little nugget in here. No matter what you're using it, because you're taking a trade loss technically, so you get to write off a trade loss. Now there's caps to there's other things. I'm not going to get into all the nitty gritty here, but just know that this is a big one. And there's no credit reporting if that's important to you or not. I'm not sure, but that's something worth noting. All right. Big picture here. Why do the numbers work like this? What exactly is happening? Because this is important to holistically understand Christoph, how are you saving $60,000 on a 5-year car loan? That's nuts, right? Well, the reality is the math works out in the following way. You're borrowing at 4 and you're gaining 9. Okay, that spread is allowing you to overcome the cost of a car, okay? And in addition, because you're making a balloon payment, and instead of paying down a principal and a loan at 4%, you're contributing to an investment gaining 9%, okay? That's basically how the math all ends up working out holistically, okay? There's also, again, the tax deduction, which I didn't include that in the calculations. I would also add that your initial contribution amount is twice as big as your debt amount. So you're gaining 9% on a large number, and you're losing 4% or 4.8% in the interest on a smaller number, half the size. So that is a big spread there to really juice up why this works. Now, your natural next question should be, this sounds all great. What are the risks? And I'm not going to deny it. There are some. Okay, we're going to go over this. There is some risks. What if the returns come in lower? Well, everybody remembers February 2009, right? I remember February 2009. 666. S&P 500 dropped it to 6. It's like a market joke, by the way. Like, we were tanking, and I could just picture people are like, oh boy, how much lower can we go? Looks like we're going straight down to oh, we bounced right off 666. I think the low was like 666.73 or something. Anyways, if that were to happen, what does that scenario look like? Here's a spreadsheet that I built to look at all of this together. All right, all the math and everything is behind the scenes in tab 1. Here's my summary. I plug in 9%. Well, give me a rate that you think you could expect safely in the next 5 years.
5%.
Okay, let's go with 5. Does it still work out? Yes, it does. You beat the normie loan. Okay, if you don't make the payments, you save $29,000 while keeping the car. If you make the payments, you save $38,000. At what point does it start to get bad? 2%? No. 1%? No. 0.005? 0.5%? There you go. At about 0.5% average return per year is where this strategy kind of breaks even.
What if your investments lose?
That's a fantastic question. Well, what does happen if you lose in your investment? The worst rolling period in the S&P 500, 5-year rolling period, was February 2004 to February 2009. Again, 666. We were not on heaven's door, okay? You were knocking on the other door. Well, you lose. You would lose in your accounts $30,000 If you did the savvy and no payment investments, if you do the savvier payment investment, you lose 38,000. What exactly does that mean though? Let's play this out. What that means is that your investment account took a hit. Well, of course it did. You lost 5% per year for 5 years. Did you actually lose compared to the loan though? That's what the question becomes. No, actually not really. Ultimately, your total payments for a normie car loan is $69,285. Your total payments before the tax benefit for the sophisticated loan is $72,900. So that spread is really your capped loss here, especially if you're already invested in the market and you're going to ride these waves anyways. Your capped loss on doing this versus the normie loan is about the $3,700 or so, or $600 and some change. That's really the loss. Question for you is, would you be willing to take that $3,000 spread as a cost of doing this and ride out that you're not going to lose in the next 5 years? I think a sophisticated investor like yourself would think that's a pretty good bet, I would say. All right, what about margin call risk, Christoph? If I borrow in 2006 all the way to 2011, what my drawdown had to be at least 50%. You're right, it was. You hit 50%, 40%. There's been a couple other times like that. And if you're borrowing more than 50%, your margin call risk is about 32%-ish, depending on the broker, okay? I have another video about this, but we're going to talk about the mitigating that risk on the next slide. And of course, there's the human life variables. Staying invested is important. You might lose your job. You got to be aware of that. You got to keep making the payments if you go with the savvier strategy. These are all the same risks of even a normie loan, frankly, so there's really not much differentiation there. So yes, if the returns are too low or negative, then this does not work. You do net lose compared to the normie, so that's a real risk. However, I would argue that the cost of taking that risk is so low compared to the upside, right? You might do this and lose $3,000 during the worst 5 rolling period time in US stock market history, or you might do this and end up making money, right? Which most likely you will. The margin call risk is real. Again, I talk about this in my other video, but you should buy insurance. Buy that put option on your investments. Take it out far out of the money, 30%, so you create that floor. It's no different than paying an annual insurance rate. And frankly, the real risk is at the beginning of an investment on this strategy, because let's say you do this in day 1 and right away the market crashes. You didn't have enough time for growth of the investment, nor did you have enough time to put in the payments. But by year 2, even 3, assuming that we did rally up, you're kind of in the safe zone of not having to buy the insurance anymore. There's a chance, of course, things might still dip way below here, but it's a little less likely, even more less likely than before. Finally, the human variable, I would overcome this with honestly setting up an auto pay straight to your broker, straight to your account. You know, just right, instant invest it. Final summary. This can be done with anything. You can buy a house, a car, a boat, vacations, anything, and do this strategy. You need the assets, or you need the cash to be able to put into an asset in order to make this work. But I'll leave it up to you, okay? Do you pay the bank, or do you be the bank? All right? Do you lock in the guaranteed loss of the car? This loss right here, this is guaranteed. It's a guaranteed loss. Or are you savvy? I hope you have a great day. Hope you get some value from this. I look forward to your comments, questions. I'm here to help in any way. Thanks so much. Have a great day.
Did you get it?
Yeah!